how small Bitcoin is in the grand scheme of things. Bitcoin's a $2 trillion asset, and you're talking about 900 trillion, I think was the number of global wealth. And a lot of that is, or at least is the case that, Saylor makes essentially, is that Bitcoin's this black hole. A lot of that value is going to go into Bitcoin. As people realize, like, real estate is inferior, art, is another big one. I don't know why you'd buy that, but hey, you know what? So be it. Equities, et cetera, et cetera. People come to realize, Bitcoin is a superior asset. Bitcoin is outperforming everything. That's the case. But, when you say like Bitcoin is pretty small, what are you comparing it to? Since it's a $2 trillion asset, I mean, $2 trillion asset that sounds pretty big from my perspective. And just to kind of give, just so that people could like visualize this in your head, El Salvador has a GDP of 33 billion, right? So, Bitcoin is pretty massive if you compare it to certain things.
Yeah, I mean, it's what is the 7th biggest asset in the world. So it's sizable enough that it's competing now with the biggest companies that exist, which is the Apples, the Saudi Aramcos, right? Silver, it just flipped silver. Silver didn't even try and fight back, just got wrecked. And then you look at like gold is kind of the biggest in the room. But then you've also got to look at just the size and scope. And I know Nick Barty has talked about this too. Like some of these entities, they can borrow money cheaper than everybody else, and they can leverage up bonds and all this kind of stuff. There's money that can just come out of nowhere. So the size and scale of these things is something else. When you look at the ETFs, for example, they've taken in about 40 billion. Now, my just rough back of the envelope checks, the ETFs are about a fifth of the market, thereabouts, right? It fluctuates, but something around there. So if you've got 40 billion coming into the ETFs, times that by 5, that's 200 billion in demand. That's pretty much about right. Now, I look, these are not supposed to be perfect numbers, but people talk about this like money multiplier effect concept, right? You put $1 in, what's the impact on the market cap? Too many people talk about 100x. It's bullshit. It's something closer to 3 to 5 by my calcs. So if you take that, the ETFs are 40 billion. They're about 20% of the demand, so that's 200 billion. So let's just say we got $200 billion of money coming in. If the ETFs were to double in size, that's approximately what that means. By my calcs, it will take to get us up to 150K, that's $1 trillion market cap. You need about 200 billion to get there. So the ETFs would kind of have to almost double to justify us moving up to 150K. Now, these are going to fluctuate around. This is not perfect numbers, but gives you a bit of a sense of scale that things have to get quite a bit bigger for us to move up to new levels. So 50% today is not the same as 50% back when Bitcoin was $100. It's a whole different animal. It is much bigger, but we are also dealing with entities who have that kind of balance sheet, right? If the companies on these 13F filings, if we just bring them up to 0.5% allocation, that takes us up to it's like $130 billion. Then that's just the demand that's going to go into the ETFs times that by 5, right? So the numbers are just enormous, but it's also going to take, you've got big money coming in, but you've also got a bigger target. And this is why things slow down. There's more time to chop around and consolidate. Derivatives are going to continue to expand. Some people say that's suppressing the price. I say you can't actually hedge your risk if you don't have them. So without derivatives, we actually can't go higher. There's all these dynamics, right? We are watching an asset class mature and reach a global scale. It's amazing that we're even watching this, but I think people's expectations can run away with them because they expect, 2017 100x type returns, maybe, but probably not over the next year.
So is it getting boring in the process? Like, is it, is Bitcoin boring now? Is it just becoming, like a big tech stock? Like, because I think a lot of, I remember seeing, James, a Google Trends. If you take a look at Google Trends and you put Bitcoin, you search Bitcoin on Google Trends, we actually haven't peaked since 2017.
That was the all-time high. Yep.
That was the all-time high on Google Trends for Bitcoin. That tells me that we haven't seen retail interest. We haven't seen euphoria level retail interest to the levels of 2017 since 2017. And I think a lot of us, we came to Bitcoin during that era. We remember those days. Are those days over? Is it just going to be a slow grind up and to the right, and these explosive moves of, I mean, it's pretty explosive seeing 60 to 100K in a very short amount of time. So, but are these explosive moves of, I believe 2017 was 20x. Are those days long gone? Are the years of 200x, 300x, 500x, are those days gone? Is it going to be just this slow grind up? And in the process, if it is a slow grind up, you could make an argument that, 50% return in a year is absolutely incredible, but compared to Bitcoin's past, it seems a little boring. What would you say to that?
Yeah, no, this is a great thought, but think about it from this perspective. This is the whole idea of compound returns. This is why you actually want to buy and stay in an asset. This is why. Because if you start buying a stock or you start buying Bitcoin in its early years, which I would argue we have left, we're kind of in that transition point into the more mature years now. Yes, the percentages may shrink, but suddenly you're talking about big dollars here, right? So if you were the owner of a single Bitcoin, right, 50% back when it was $100 gives you an extra $50 in your pocket. You can go and get 2 hamburgers. 50% now gives you $50,000. So what happens is your percentages decrease, but the dollars that's moving are much, much larger. So basically, the longer that people stick around and hold any asset, this is the same for anything, the percentages will decrease as it gets bigger, but the amount that moves, how much that changes people's lives gets much larger. And you'll often see in Twitter, people will say, oh, it's down $10,000. It's like, yeah, that's 10%. Like in a percent terms, and that's what a lot of people think in portfolio percentages. So when you think about a 10% drawdown, it doesn't look scary, but that's a $10,000 move, right? That's a significant pullback for most people. But it also works on the other side. And I think it's important to remember that as we get bigger and these big firms come in, so where we're leaving the retail-dominated world. And I do believe a lot of retail have not actually come into Bitcoin. I think they're going into everything else and kind of paying the price for that. Bitcoin, I view it as a savings technology. For me, it's never boring because, I write my newsletter. I always find something fascinating to write about it. So for me, I'm endlessly engaged. But when we think about how people kind of behave in these markets, the more that Bitcoin chops around, the more it actually changes the dollar value, right? So people's savings are going to be affected by this thing. And that's what I find with a lot of my subscribers. People say that, this is my life savings. I actually want to understand what it's doing, how it's moving, because I treat it that way. And the final thing I'll say is that retail, when we come in, we earn our paycheck, we put money on the table, we buy spot. Because we had to earn the money to buy these things, to buy the Bitcoin in the first place, we respect it a lot more, which means we actually can weather 75, 80% drawdowns. You wait, and this is what Nick Barty has been talking about. You wait until these institutions start borrowing some other guy's money and they know they've got a bailout behind them and they can start to juice these returns left, right, and center. What's going to end up happening? The volatility can actually explode in both directions, but to the upside as well, because these institutions can over-lever themselves, right? So we're dealing with much bigger weapons now, which means, yes, the volatility can compress most of the time, but there will be periods of time when Bitcoin just absolutely rips faces and it explodes to the upside. There'll be volatility in both directions, but some of these hedge funds and things, they can blow up as well. And they're blowing up knowing that they've borrowed someone else's money and they've probably got a bailout behind them. So that's where the real volatility can come from and actually get more insane as the numbers get bigger.
So let's talk about that, the institutions, right? You're talking about all this big money that's flowing in and, all this insane amount of interest. So who is this? Are we talking about pension funds? Are we talking about the ETF BlackRock? Are we talking about nation states, sovereign wealth funds? Like, who is this big money that you're talking about? Is it here? Is it going to continue to just buy a Bitcoin? How do they view this asset? Because I think we've really seen, I think 2024 was the year that Bitcoin entered the mainstream political discourse. And I think at least here in the United States, there was a specific party, trying to be inclusive in my messaging here, that took a, let's say, a hostile stance towards the industry, and they really made a big bet. And I think you can make a very strong argument that they lost the election because they took a specific stance on the entire industry, and they essentially galvanized our industry. They forced our industry to throw our hat in the ring, and now all of a sudden we have a seat at the table in Washington D.C. Bitcoin has become part of the lobbying, the lobbying class, so to speak, which I find absolutely hilarious. In a way, 3 days before Trump gets inaugurated, Trump coin. It's insane.
It is.
But like, what is this big money? Who are you talking about? What are you seeing that the rest of us aren't seeing?
Yeah, so like, I think the funny thing is that no one can't see this. At the end of the day, if you look at the Sharpe ratio performance, which is what a lot of these fund managers work off, if you look at the performance of Bitcoin and you just are intellectually honest, you cannot say we should have zero allocation. So we're starting that there's different pools here. There's going to be in the early days of the ETFs, I think there's two main buckets that have come in. The first one is probably people like you and I being like, hey, cool, I can put my retirement assets in here. I think there's been a lot of Bitcoiners who've gone, great, now I can put some retirement money into this thing. And I just thought about it, right? Bitcoin's 16 years old. Where is it going to be in 35 years when I can access my retirement? Probably not 100K, guys. It's going to probably be quite some chunk larger than that. So I think there's a lot of that, which is going to be asset managers. It'll show up as like the BlackRocks and the like holding those assets. But you've also got a lot of hedge funds, but also big firms who are just like, you know what, I can do a cash and carry trade. I can buy spot, I can sell futures. They still have to buy the spot position. But so long as there's like positive momentum in these markets and futures trade at some kind of a premium, they can essentially just buy the spot, lock in that arbitrage, and they just keep rolling that position, right? They're holding those coins. There's going to be the likes of pension funds. And this is really what Michael Saylor's been trying to tap into. Some of them can only buy a certain allocation to bonds. He's creating bonds that have a Bitcoin tether or a Bitcoin tie. He's creating these bonds that service the role of these pension funds. We're seeing Allianz was like 25% of their demand. So at the end of the day, institutions are profit-motivated actors. If they take a directional bet, it's usually going to be a long-term one. This is where you get your pension funds, your sovereign wealth funds. These are long-term asset allocations, same as gold. You'll see some hedge funds that come in just for the trading aspect, just for the cash and carry, just for the arbitrage. They'll lock in premiums on options. All of these, like this is the thing, Bitcoin is now maturing into an increasingly complex asset. And I think that's what a lot of people miss is that we really have to look at what's going on in options, in derivatives and futures, in spot, in exchanges. All of this stuff matters. ETFs, these are just all different lenses into how Bitcoin is trading. And if anything, your favorite Bitcoin hater, Mr. TradFi, who's been rallying against it forever, I bet you any money on a Sunday, if something happens in the world, he will be posting a Bitcoin price chart on Twitter because it's the only thing that tells him what his stocks are going to do on Monday morning. It is the global index. It tells us where liquidity is moving. It's a signpost. And that makes it immensely interesting for everybody, from traders, investors, hodlers. It is the asset you have to have on your dashboard. And I've spoken to some serious, money guys. That is their dashboard. They have Bitcoin as one of their indexes because it tells them information. That's what makes it so interesting.
100%, because it's trading 24/7, right? Like today,
it's the only thing that can respond.
It's President's Day, right? So the stock market is closed. There's also been some things where, on the weekend, Bitcoin drops like 15%. The stock market that Monday is going to start off rough. So I 100% agree with you. It's the actual thing that really does have a, pulse on the finger on the pulse of the global markets without any type of government interference or any type of, nothing could really stop it. It's always ticking, right? It always has that heartbeat. So that's a really, really, really good way of putting it. So I think next
sorry,
question,
just to jump in there, the thing that fascinates me, this is why on-chain data is so interesting. On-chain data is the sentiment of all the people who hold that index. That's Beautiful. What makes it so interesting. I get to see when people are buying high, selling low, doing good decisions, making bad decisions, hodling, whatever. That's what on-chain data is so interesting for, because it's like this immutable record of our human decisions. That's what makes it so fascinating. So if Bitcoin is this global asset that tells us about the world, I want to look at the sentiment of the people who hold this weird thing, right? That's endlessly fascinating.
Need liquidity without having to sell your Bitcoin? For more than 6 years now, Ledn has been the trusted choice for Bitcoin-backed lending with transparency, security, and trust at their core. I absolutely love these guys, and I personally have not only an account with them, but also a loan. And some of the key features that I love about Ledn is the fact that there are no monthly payments. You pay at the end of the term. You also have the ability to roll over the loan as well, and you can pay it back whenever you want. Essentially what they do is that they help their clients unlock the liquidity of their BTC, allowing you to HODL while still accessing the wealth of your Bitcoin. They've been battle tested with their focus on transparency, security, and trust, allowing them to build a proven track record of client success and security, helping tens of thousands of clients harness the value of their digital assets with confidence and peace of mind. Learn more about what your BTC can do for you. Check out Ledn.io today.